Okay, so today we're going to be going over the conceptualization of iron condors. So when people first start learning about options, they have difficulty conceptualizing a spread more than they do a straddle or strangle. This kind of adds an extra layer of difficulty in attempts to conceptualize an iron condor. So many people out there that teach options will try to teach an iron condor using two spreads, which is what it is. However, in my experience, people can conceptualize iron condors in a more efficient manner by learning them this way. So here we have our little stock here. It's kind of rudimentary, but you get the idea. We all should know what a long straddle is. For those of you that don't know, in a long straddle, you're basically making a bet that the stock is going to move a significant amount one way or another. We don't know which way, we just know it's going to make a move. So a long straddle would be buying a call contract and buying a put contract. If we want the inverse, a short straddle, it would be the exact opposite. It would be selling a call and selling a put, being short both. So we're betting that the underlying stock will stay within a specific range. So using these two concepts, we can explain exactly what an iron condor is. So we take the short straddle, so we'll go right here and put a call here. This is going to be a call that we sold. So we sold it, we'll make it red since we're short. So that's our short call that we sold. And then we're going to sell a put as well. So we'll come down here and we're selling this as a put. Alright, so now we're short a call right here and we're short a put right here. So what we just want this stock to stay in this range, and as long as it stays in there, then we're fine and we keep that premium for which it was sold. Just as in a short straddle, in an iron condor, we're betting that the stock will stay in between those two strike prices, but all we're doing is taking that short straddle and then we're going to add that long straddle to it. So this is going to be a long straddle. So this is our long call that we just bought, and this is our long put that we just bought. Okay, so if these red lines were not here, we would have a long straddle, this long call, and this long put, and we would want the stock to move outside of that range. In this short straddle, the two red lines here, we want it to stay in between. All we're doing is still maintaining that same strategy that it will stay in between these two short strikes, the red lines, but we're adding this long straddle out here to kind of cover ourselves and give ourselves a max loss. So here we have an iron condor. In between these two red lines, that'd be a short call, long call, and then you got short put, long put here. So same strategy, like I said, we're just covering ourselves down here to limit our max loss. Now this will limit profit, but it'll reduce your margin requirements, and like I said, kind of cover yourself in a worst case scenario. And that is the conceptualization of an iron condor.